Coming up on Market to Market, the Obama administration unveils its version of the 2015 budget. The U.S. House makes its 50th attempt to overturn the Affordable Care Act. And tensions in Ukraine push U.S. commodity prices higher. Those stories and market analysis with Sue Martin next.
This is the Friday, March 7 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. While Old Man Winter kept consumers inside last month, job seekers were undaunted by the inclement weather. According to the Labor Department, the unemployment rate rose to 6.7% in February. Though higher than January's 6.6%, the news is encouraging because more people were looking for work. The number of jobs created last month hit 175,000, up 12% from January. However, the harsh winter weather did keep more employed Americans on part-time status as factories reduced hours or closed. The cutback was the largest since the Labor Department began keeping records 36 years ago. Crude oil prices rose to over $103 per barrel at the beginning of the week as tensions between Russia and Ukraine increased. By the end of the week, prices had moderated as the former Soviet-era giant pulled troops from the border, and the Energy Department reported higher domestic crude supplies. All the news pushed Wall Street higher as the Dow Jones Industrial Average brushed record territory, and the S&P 500 finished the week with an all-time high. Despite a worldwide focus on events in Ukraine, the Republican-controlled U.S. House of Representatives made an unprecedented 50th attempt to overturn the Affordable Care Act, also known as Obamacare. The measure delaying the controversial health care plan passed on a vote of 250 to 160. The legislation stands no chance of passage in the Democratic-led Senate, and the White House has threatened a veto. As administration officials swat away another piece of housefly legislation, the White House released its version of the 2015 federal budget. Republicans have dismissed the new trillion-dollar plan as nothing more than an election cycle Democratic manifesto. They argue that retiring baby boomers and ever-rising health care costs will run the federal debt to unsustainable levels.
It's a roadmap for creating jobs with good wages and expanding opportunity for all Americans.
President Obama sent Congress a $3.9 trillion budget blueprint Tuesday that calls for increased spending to boost economic growth. The more than 1,400-page proposal also aims to tame the national debt by raising taxes on the rich, squeezing payments to healthcare providers, and overhauling immigration laws. The budget includes new spending for expanded preschool education, job training, and public works. And it increases the earned income tax credit for low-wage workers while separately adding more than $1 trillion in higher taxes over the next decade.
This budget gives millions more workers the opportunity to take advantage of the tax credit. And it pays for it by closing loopholes like the ones that let wealthy individuals classify themselves as a small business to avoid paying their fair share of taxes.
Republicans immediately rejected the proposal, saying the red ink, spending hikes, and tax increases mean the plan is dead on arrival.
The president has once again opted for the political stunt for a budget that's more about firing up the base in an election year than about solving the nation's biggest and most persistent long-term challenges.
The recently enacted 5-year farm bill was not spared from the administration's pen. Proposed cuts went beyond already adopted subsidy cutbacks by looking to scale back crop insurance. The 2015 budget proposes around a 15% cut in the $9 billion a year program, which partially subsidizes both the companies that sell crop insurance and farmer premiums. There will be little support for that reform in Congress, however, where funding for crop insurance has been a priority.
I think this budget is based upon a philosophy that you can tax, spend, and borrow and regulate your way out, your way to prosperity.
The Obama administration also proposed doubling dollars for broadband access to the neediest, most rural communities. And the FDA, which oversees most foods, would get a boost of $24 million to put a new food safety law in place. When adding in the cost for food assistance, which makes up the bulk of USDA's budget, the proposed allocation is 8% lower than last year. Overall, the government would still be left with a nearly $19 trillion deficit, despite a proposed savings of $5.3 trillion over the next decade. Congressman Paul Ryan, the House Budget Chair, is expected to release a Republican version of the spending proposal in the coming weeks. The citizens of Ukraine rose up last week and threw out their president. With his escape amid the confusion, he took his pro-Russian leanings with him into exile. A clearly Western-leaning temporary administration was installed, and elections have been scheduled for May. Russian President Vladimir Putin dispatched troops to the border as part of a military exercise. Tensions ran high as Ukraine prepared for a shooting war with its former Soviet overseer. Putin eventually pulled his troops back from the borders, but left soldiers on the Crimean Peninsula to protect Russian speakers. The semi-autonomous region also is home to Russia's Black Sea Fleet. Even though tensions may have been reduced to a standoff, the world is left to watch and wait as Ukrainian commerce and lives stand in the balance. Recent protests in the Ukrainian capital of Kiev gave way to deadly riots last week, rooted in the country's abandonment of pro-Western ties. Ukraine, a former Soviet republic, had sought to strengthen relations with Russia under its now ousted president. Amidst the chaos, Russian troops rolled into Ukraine's semi-autonomous Crimean Peninsula early this week in an alleged attempt to safeguard ethnic Russians in the region. The aggressive move was quickly condemned by the international community, while Ukraine's new interim government classified Russia's occupation as an act of war.
Crimea is the territory of Ukraine. And despite the presence of Russian military, despite the fact that Russian military supports an illegal government, we will tackle this problem.
The Russian Navy's Black Sea Fleet is strategically headquartered in southwest Crimea, with a lease on the base until 2042. Initially, markets reacted bearishly to the standoff between Russian and Ukrainian forces. Russia's stock market crashed as the country's benchmark index fell 12%. The plunging ruble riled up currency markets as Russia's legal tender dropped 2.5% against the dollar on news that EU members had postponed aid money, pending a review by the International Monetary Fund. Shockwaves rippled through the commodity markets in reaction to the turmoil overseas. Gold soared to a 4-month high, pushing the precious metal above $13.50 per ounce. NYMEX crude closed above $104 per barrel at the beginning of the week, and the potential for conflict triggered a 36-cent spike in the March wheat contract. According to USDA, Ukraine is the 5th largest grain exporter in the world, responsible for over 6% of wheat supplies and 16% of corn across the globe. While economists don't expect worldwide grain supply to suffer in the near term, an eruption of violence in the region could cause significant disruptions for spring planting. A midweek rally bolstered economic prospects as Russia appeared to de-escalate the conflict, though no troops were withdrawn. But prospects of a solution were short-lived when days later the Moscow-backed Crimean parliament put forth a referendum to allow Crimea to secede from the Ukraine and become part of Russia. World leaders responded swiftly, pointing out that the legal move was a violation of Ukraine's constitution and international law.
This morning, I signed an executive order that authorizes sanctions on individuals and entities responsible for violating the sovereignty and territorial integrity of Ukraine or for stealing the assets of the Ukrainian people.
Next, the market-to-market report.
The threat of conflict in Eastern Europe, higher export sales, and the potential for increased worldwide demand move the grain markets higher. For the week, May wheat gained 51 cents, while the nearby corn contract moved 25 cents higher. Weather concerns in South America and strong foreign demand continued to support higher soybean prices as the May contract gained 43 cents. Nearby meal traded sideways with a gain of 10 cents per ton. In the softs, cotton reversed its recent decline as the May contract rose more than $4.10 per hundredweight. In the dairy market, April Class 3 milk gained 44 cents, while the deferred contract was nearly 20 cents per hundred higher. Over in livestock, the April cattle contract lost $1.72. Nearby feeders gained 58 cents, and the PED virus continued to pressure April lean hogs higher as it added $6.15 to last week's close, setting an all-time contract record. In the financials, the euro gained nearly 5 basis points against the dollar. After a wild week, crude oil advanced by 3 cents per barrel. COMEX gold gained $16.90 per ounce, and the Goldman Sachs Commodity Index moved almost 4 points higher to settle at 653.25. Here now to lend us her insight on these and other trends is one of our regular market analysts, Sue Martin. Sue, welcome back.
Thank you, Mike.
It is a busy week in the grain markets.
It's been wild.
Let's talk about the wheat market. That's where we've seen the most strength. Is that predominantly coming out of the Ukrainian situation?
Well, it's a cluster of a lot of things. First off, the Ukrainian situation is enhancing it because the Black Sea region does compete very aggressively against U.S. exports. Russia's a very large exporter of wheat, and so is the Ukraine. But the Ukrainian campaign on wheat exports is just about done. There might be, it's estimated between 4.7 to maybe 7 million metric tons of wheat left to get out the door. It was the corn that was to be started next. And of course, Ukrainian farmers are hanging on to that corn because the Ukrainian currency is falling through the floor. And they look at their crops as something worth more than just the currency. So they're hanging on, and the uncertainty with the food. But beside all of that, you've got the Middle East. There's countries like Syria, Lebanon, Iraq, Palestine. You've got countries that are looking at drought and have been the driest this winter over several decades. And they are large wheat users. And so it's going to be interesting. That's an area also of a lot of unrest. So that's another situation starting to percolate. And then you've got Australia, who's dealing with the possible forming of an El Nino. They've already had a drought this past year. And while their crop did come off okay, it's going to be this next season that's going to be of concern. The open interest in the wheat market's the lowest that it's been since 2009. And usually when you have extremely low open interest in a market, it's pretty much done going down. Everybody's short that wants to be there, and everybody else has left that can't stand to be short. So the market has one other direction to go, and it's back up.
So wheat looks like a buying opportunity at this point.
I think so. All my technical indicators I use are very positive on the longer term. And I think that when I look at wheat, I think wheat's got potential for maybe close to $1 rally yet before it's done. It may take a little bit of time. And another thing, we don't know the condition of our U.S. wheat crop. Wheat went into dormancy in very good crop conditions, some of the best conditions we've seen in years. Now, all of a sudden, as it comes out, we're thinking it might be, all of a sudden going back the other way. So wheat's got some story here.
All right. It was a very deep freeze across much of wheat country
very
in America.
Much. And another thing, International Grain Council here about a week or so ago lowered global wheat production underneath the total of what usage is expected to be. That's bullish. And then if you take the U.S., world's largest exporter of wheat, and you take, and maybe even if it's just a shy 10%, well, I hate to say it, but that's cramping into the style of production that needs to be a little bit more so we can stay in tandem with our usage.
All right. Now, as we look at that, a potentially shorter wheat crop this year, are we going to see a lot of spillover support into corn as we look at some of the deferred months?
Absolutely. Corn and rice both. Argentina's not exporting wheat either. I mean, they've kind of come off with about 500,000 metric tons of export licenses, but not much, I don't think, has gone out the door yet. And they're not exporting corn. They're not exporting soybean meal and soybean oil, and they're the world's largest exporters of that. So corn does have a story underneath, too. Here again, a market that got too cheap. Tractors cost a lot. Combines $500,000 by the time you buy the heads. $5 corn, it's not overly priced. And in the meantime, you've got farmers holding on to a lot of corn, but some of that's been moving with these rallies, and I suspect more is going to have to move as we warm up with the weather. Still, now with a lower forecast of acres this year, and now the potential of a later planted spring, boy, that's going to put some fear that we lose more acres yet before this is all said and done. And that's kind of infusing a little bit of rally here in the corn market, too. We had $5 corn on Friday, and, in fact, we got over $5. July contract got to $5.06, and the December got up to $4.93. So we're getting into areas that psychologically is pulling a few sales out by the farmer, and that's a good thing. But I don't think we're done yet.
All right, so would this be a good time to maybe make an increment of sales on the new crop, looking at the Deese contract, or would you hold off and try to catch 5 or a little higher?
I think new crop corn's got a chance to still move a little better. I don't think we're done yet. In fact, the corn market might absolutely surprise us when it's all said and done. The one thing is the feed usage. I think feed usage has been way better than what was expected. Part of it is we have to remember in 2012, our harvest started on corn in late July. And there was a lot of old crop corn that got commingled, I should say new crop corn commingled with old. Now in 2013, the opposite happened. We had the crop harvested extremely late, and so we didn't commingle anything. I think that the usage has been good. You've had an extremely cold winter. We're feeding the hogs heavier to compensate for the loss of pigs. We're feeding cattle heavier because they're trying to capture all the money they can at record prices. I think that we're looking at a market here. DDGs got extremely high. China had been buying aggressively and running the price up. Then they canceled 10 to 15,000 metric tons. Prices fell $100 a ton. They came right back in 3 weeks ago and started buying again. So in the meantime, you've got feedlots. They'd much rather feed corn even than DDGs if they can, if it's cheap enough, and they've been doing that. So I think the feed usage has been very good. In the meantime, the processing for ethanol has been pretty aggressive, but that said, I'm hearing a lot of ethanol plants are bought up through May. So that could be a little adversity a little bit later on down the road.
All right. Now, let's talk about soybeans. You mentioned China canceling some orders of DDGs a little while ago. The exact opposite. In the soybean markets, I don't believe we've seen a cancellation yet, have we?
Well, we have, but they haven't been big cancellations. China is slowing a little bit on their usage of crush or for the crush, but it's mainly because they're in the process right now, while they've been slowing down with the bird flu and what have you, they're basically filled up. Their coffers, our storage facilities are full. And so they can't really get beans moved into the interior, into where the crushing plants are. And they're basically crushing and filling orders that they had from last year. In the meantime, you have vessels sitting at ports that are sitting there full of beans, and they're just basically using them as storage. So I can see maybe a few more cancellations. I don't think it's going to be anything major. Basically China's been taking the beans from us as fast as they can go. But right now the price of beans is getting a little bit maybe rich for over there. So we could see a little slowdown, but it isn't just China. We're sending beans all over. And then domestically, our crush demand has been horrendously strong. And that's because we have to thank Argentina for that. Their crushing capacity right now is running about 60% of normal. And that's because farmers just aren't selling those beans. Export taxation is 32% versus 20% if it's crushed. So they're hanging on to those beans just like the Ukrainian farmer holding on to corn.
You bet, a hedge against inflation in both those places.
Exactly, and so that's shifted that demand to the U.S., and our crush has been good.
Now, we have seen a nice rally on new crop beans. Would this be a good time to get in there and make some sales, or do you hold off, or are you bullish new crop beans?
I'm very friendly new crop beans. I don't think our high's here. And that's even in the face that I know we're going to pick up acres. And, of course, if we have a late spring and it's cool and wet, well, then we're going to pick up some more. But in years ending in a 4, since 1914, so the last 10 of them, every one of them, November beans made new highs for the year over the previous year. And if it's even just a contract high, that's 1333 on November beans. If you look at March 1st stocks, and when all those stocks of Western Hemisphere stocks exceeds the previous year by 4.8 million metric tons or greater, which it is, then I went back, there's 14 of those years going back to 1976. And what was interesting was November beans made higher highs those years, with the exception of maybe 4 of them, and those 4, you looked at the high of the previous year. So I think $13 beans is fair game for new crop beans. Still, today we got up to right at $12, $11.97 the market fell 25 cents in a New York second. So if a producer's concerned, because, you know, there is a lot of money on the table, maybe buy an 1160 put and you'll have about 1104 locked in and then just walk away. I really highly recommend to producers, do not sell calls. Leave that top side open because this is an interesting year we're in.
Could be an interesting summer.
Yes.
Now let's take a look at the cattle market. Fat cattle we saw fall on the board this week, down a little over $1.50. Have we topped out on fat cattle, do you think?
Well, I'll tell you, 90% of the traders that analysts in the cattle market that I think are worth a salt all think so. They're looking at any bounce here to sell against that 45.50 to 145.50 to 46 area. I'm not so sure. You know, I can see the huge reversal that we got. We've started Lent. Interestingly, the top came on the first day of Lent, Ash Wednesday. But on the same token, you know, our hot beef is back up towards 235 to 240. That's the all-time high, granted, that we seen back in January. That did cause kind of a backup by the consumer, but that was also right in the very heart of bitterly cold winter weather. And we're now moving towards spring. And I think that maybe people have got so much cabin fever, you give them a little nice weather, they're going to be going out to eat. They're going to buy that hamburger. They're just going to maybe make the hamburgers a little bit smaller. And they'll buy the roast and they'll stretch it. But the consumer, you know, if you look at our consumers, we have a large older population. They don't eat as much as they used to. So, and they will try to conserve their dollar, but they don't eat as much. It's the younger generation that's kind of spoiled and likes what they're used to having what they want. They'll find a way to have it. And don't we all want something we can't have?
Well, now let's take a look at the feeder cattle market. We saw a little rise this week in spite of corn on a nice rally. Do you think that's going to continue?
Well, feeders are very high priced. I have to admit that. And you look at the June cattle on out, and they don't make it look real attractive. But when I look at feeder cattle, I think right now I would say if there's going to be a nicer rally, I think it's going to end up being more so in the fats than it should be in the feeders. Feeders will come along. 181.50 is a wave 5 on the feeder cattle for May futures. Boy, I'd be a little bit you can see how the market is struggling trying to get there. And you get up around that 175 and it has problems. So I think it's a little bit concerning to be too bullish feeder cattle at this time. And I certainly would be doing some hedges, certainly via puts, and of course at some point we're going to have a huge break in this feeder market. You know,
pull back.
The traders never thought corn would rally, and that's kind of surprising them. What if it rallies more? You know, that's going to hamper demand, I think, on feeder cattle. But these fats, wave 4 is 151.50, and we haven't quite gotten there yet. And wouldn't you think you have the bullish campaign to do that?
Yeah. Now let's talk hogs real quick, Sue. Up $6 this week. Do you see more upside in April hogs?
Well, April's are leading the way. You know, it's interesting. Come Monday, Russia is supposed to start taking U.S. pork. And I've been just holding my breath for fear that President Obama will put an embargo on that pork and keep it here. But he hasn't done that. You know, will he do it with food? I don't think so. Food's a pretty major thing.
All right.
But I tend to think the hog market's pretty lofty. We've already hit a wave 4 on the Junes.
All right. Thank you so much, Sue. That wraps up this edition of Market to Market. But you can find expanded market analysis as well as streaming video of our program free at our website. Now, we want to remind you that Market to Market may be airing in some different time slots and in some cases even on different channels over the next few weeks due to PBS fundraising activities. We encourage you to check your local listings for details. And if you value programs like Market to Market, please continue making a pledge and investing in a service that provides you with accurate information and timely market analysis. We appreciate your support. And until next time, thanks for watching and have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content.